Hello, welcome back, investors, to the Swing Trading Channel, Stock Planner. The war in Ukraine really sucks. Lately, Russia's been taking some very aggressive actions, targeting grain elevators and threatening ships. It's a possibility that food shortages will result. Ukraine was and is the breadbasket of Europe, and this is the type of facility that Russia is targeting in order to starve out Europe and Ukraine and win the war. So far, shipping has gone relatively unaffected. And if there is a food shortage, I have got 3 stocks that I want to discuss with you today that you may profit with and swing trade. These 3 stocks are high quality stocks, and they may even help you fight inflation in a recession. We're swing traders, and we're looking for the tops and bottoms and trying to capture the trend in between. Bottoms and tops and that trend in between. We use several different indicators. This is a zigzag. It's not an indicator at all. It looks to the future and paints these tops and bottoms perfectly by using future data. You can't use it to trade. But I use other indicators, the MACD. When the MACD is well below the 0, that might be a time to go long. When the stochastic is below the 20 and come back around, that might be a time to go. And when the RSI has gone below the 30 and come back around in the last 2 or 3 bars, that might be a time to go as well. And so when all 3 of those indicators occur around the same time, possibly that's a time to go long, and that would have give you a nice return. But you can't always use the charts to trade. You have to pick some good stocks based on the news. So let's take a look at 3 stocks. The first one we're going to look at is John Deere, and we're going to look at the chart. See what the chart's telling you, if now's the time to buy or kind of wait, and then we'll try to figure out fundamentally what this stock is doing. John Deere. John Deere, the future of farming. That's an automatic sprayer. Can you imagine an automatic autonomous driving vehicle? John Deere is an iconic American farming company that has been making waves in the agricultural industry for a long time. Not only does John Deere manufacture tractors and farming equipment, they've invested heavily in cutting-edge technology for automated farming. Yes, I believe a computer can do better farming than a farmer. By developing a fully autonomous tractor that can operate with minimal human intervention, John Deere is posed to increase crop efficiency in the face of rising wheat prices and global growing population, and the war in Ukraine. This forward-thinking approach makes John Deere a solid choice for investors looking to benefit from the food shortages that are sure to come in the near future. Let's take a little deeper dive into John Deere. The Deere company, ticker symbol DE, over the last 7 days has been, well, 5% increase going up. Over the year, 37%. That's cool. Looking at Snowflake, it pays a dividend. It's a very stable, healthy company. It has a good, solid financial history in the past. But the future, it may not be growing so fast. We'll have to check that out. And it's only slightly undervalued, okay, according to the Snowflake. Let's see. It's only slightly below, yes, the PE ratio for the market. The PE ratio is an indicator that we use for valuation. Earnings grew by 50% over the past year. That was cool. And it's trading at good value compared to the industry, as we just said. You can almost tell that from the Snowflake. Yeah, so this fluctuates very nicely. That's why I like to swing trade it. It got nice tops and bottoms. And it looks like it's at a top now. The earnings warrant your attention. Okay. Companies that experience earning growth should see a similar trend in their price. We're making more money, the price should go up. That makes sense. Revenue, and then the blue line here is earnings, and that's got an upward trend. That's what you want to see. Price earnings ratio versus its peers. There's Caterpillar and Toro. I never traded the Toro. And here's John Deere. Its PE is in its undervalued area. These are the overvalued. But these 2 stocks here may be a better value. I've never traded either one of them. But John Deere seems to be a good value based on its price to earnings ratio. which is about 4.5. And this is the price to earnings ratio versus fair ratio, which the fair ratio is what it should be if you take into account earnings growth, profit margins, and other stuff, other factors. And it says it should be 21 or 22%, 22, and it's currently trading at 4.5. So again, this should catch up to this if you're buying John Deere. This is what we want to do for the long term. Now, if you look at the future value or fair value, the current price this is expensive stock, $422, but the fair value of, if you take into that free cash flow, it should be about 361. So fair value, it should be 361, but it's currently trading a little higher. So that means that you might want to, if you might want to wait till it comes down just a little bit in price or a pullback to buy. Now this chart might look a little bit busy, but it's really not. At some point in time, right here, the analysts predict on this purple line what the price will be at that point in time. Okay, and it eventually got there, and it's not too off. Analyst predictions. This is the actual. The blue line is the actual price, and then we're looking at today, where the share price is $442, and the average 1 year price target, the average analyst, and there's 24 of them getting paid to do this, is 449. It's about 1.6% average growth over the year. That's not a lot. So these 24 analysts are saying that this price of this stock is not going to change much over the next year. Now, analysts get it wrong a lot. But these guys seem to be pretty spot on. So it's looking like to me that John Deere is a very safe stock to put your money in, especially if you think you're going to have a recession. It's going to do good if the war in Ukraine continues, but don't expect phenomenal price growth. Let's look at the chart. So that the analysts say it's going to be 449. Oh, we're right there. 449, right about where only a little slight increase, about where it's at now. The stochastic above the 80, come back around. The RSI is above its 70, and it looks like it wants to come around. It hasn't yet. And the MACD is above the zero line. That's the normal time when I start looking for it to reverse a little bit and pull back. Now, we think that John Deere is going to be positively affected by the war. So you look for a pullback, but it's not going to pull back much. And we think it's going to go in this area here, trading in this area around. Or if you're guessing, which we are, in the 50% retracement, it'll pull back to the 50% and is trading in this area. So let's see if we can find some option strategy that's trading in between about 460 and 400. 460 and 400. Remember that, 460 and 400. So we go over to our option strat, which is a free simulation tool, visualizing. Then we go to optimize. And we're positive on this, but we don't think it's going to rise a lot based on what the analysts say. 460 and 400. Let's see if there's a neutral strategy out there with our John Deere. So you type in John Deere, you select neutral. These are the options that they come up with. And we're going to select the Iron Condor. Make sure September 15th, 53 days out, expiring on the 15th of September. And let's just see if we got that. Well, it's not quite 400. And it does give us our 473. We don't like this max loss. Let's play with this a little bit. Bring our strikes in, and our max loss now is about $1,000, and our credit in our pocket immediately is $967. And if it stays in between, now this is 420 and 460. That's a cool there. Let's move this one down a little bit. So our strikes here are 10 wide, 413 and 456. That's not quite what we wanted, but it's close enough. But I don't think it's coming down in 2 months to 400. We have a net credit of $675 and a max loss of $325. And I can deal with that. Let's just take a look at that again. So our break evens are 413. Let's move that up, and 456, 457. So you have to ask yourself, is it getting down in this area again? It is likely that it will. You want it to stay between here in the next 56 days. It can go up and back down around, but as long as you want to expire in this area here in order to win your full credit of $675 and your max loss is, it's again $325. You have to have $1,000 in a margin account to do this trade. And based on hitting those grain elevators by Moscow and Russia, and based on the situation with our economy, and that the market is a little bit overheated, I kind of like this trade. Leave a comment below and tell me your opinion. Is this stock moving? It certainly is. According to the zigzag, it's moving. Or is the trend kind of fade out a little bit and slow down based on the overall economy being overheated? The indicators seem to think it's going to reverse, and trading is no guarantees. You got to take facts, information, and make a trade. It's now 9:50 in the morning, and I'm going to go ahead and check the market and see if I want to make this trade. Our next stock that might be good if there's a food shortage is Archer-Daniels-Midland. They're into everything. Archer-Daniels-Midland is a giant in the agricultural industry that plays a critical role in managing the supply chain of the food ingredients. They process it. Archer-Daniels-Midland acquires basic commodities like wheat, corn, and refines these products into cooking oils, and then transports these goods around the country and the world to meet consumer demands. Despite facing significant disruptions in the global food supply due to low crop yields and the war in Ukraine, ADM has remained profitable and is witnessing a steady growth, as we'll soon see, in its food and ingredients operations. And this company pays a reliable dividend, currently at its all-time highs. Let's delve further into this stock. Looking at Simply Wall Street, and this is what you want to see. You want to see a big green snowflake for a good, solid company, especially in these uncertain times. Even though we're in a so-called bull market, you can tell a lot by the snowflake. You want them big and green. It pays a dividend. It's very healthy, had a great past history. It's slightly undervalued, and the growth doesn't look so hot. Let's see if those things match the words. Price to earnings, and that's how you see if a stock is undervalued. It's undervalued only slightly. The U.S. market is 15.8. This is price to earnings ratio is 11.3. Earnings grew by 15% over last year. Reliable dividend of 2%, and it's trading within good range of its peers and industry. This is where the problem is. Earnings are forecast to decline by an average of 10% per year for the next 3 years. When earnings decline, price declines as well. Some of his peers, and there's Bunge, and I'm going to talk about that in a minute. That's my third stop. But Demonte, I've never traded it. It's an old name. If you're swing traders, it's nice swinging stock, and we're on an uptrend. Recent earnings exceeds the analyst expectations. The increase in profit margin was driven by lower revenue. If you're going to buy this stock, you want to have a low value. You want to be good value, especially amongst its peers. And there's the peers. There's Bunge. These two are undervalued based on the price to earnings ratio. Cool. So this is just another chart to say, hey, the current PE is 11.3 and a fair PE for this stock, and it should be about 16.9 or 17%. So it's undervalued according to the fair ratio. And the fair ratio takes into account of the company's forecasted earning growth, profit margins, and other risk factors. What the company's going to do or can do. Free cash flow is another method of evaluating stock. Current price is $86, and the fair value of this stock should be about $77. It's a little bit lower. So this stock might come down. And then we got the analyst projections. And right now the analysts are predicting that this stock is going to go to 94, and it's at 86. That's not it's about 10%. So it's got a little red check mark here. Target price is less than 20% higher than the current share price. So if you're a swing trader, you're looking for a little higher percentage. And when I don't get that, I'll use option spreads. In other words, I'll say that the stock is going to stay below a certain price, like 10% below above, and if the stock stays below that, I'll have a winner on my hands. This stock is covered by 14 analysts. A lot of times, if you're trading some stocks, you want to have good analyst coverage. Stocks that only 1 or 0 analysts are covering, I don't know, it's not worth their time. It may not be worth your time. These analysts get paid for this. Me and you, we have to earn our money the hard way. Now, this is revenue, and you want that to go up. And that's not going up. That's going down, and this is a flat line for your earnings. Archer-Daniels-Midland is a safe, strong stock, but according to the analysts, it's not going anywhere. Let's take a look at the chart. So we're looking at Archer-Daniels-Midland, and it looks like it's a good swinging stock, and it's in an uptrend. The MACD is well above the 0 line. Stochastic is above the 80, and the RSI is above its 70. It hasn't come around yet. Usually, if it's going to go down, you want it to cross over its 70 for the RSI. And this looks like a nice, strong 2 days of candles. ADM is definitely in a strong uptrend. And today, the Fed, I don't know what the Fed's going to do to ADM, but everybody thinks it's going to be a increase in the interest rate 1 more time or 2 more times, but I don't know if that's going to be have a positive effect. So you may want to say, hey, look, over the next 2 months, I don't think it's going to go above 90, 91, 92. So we're in that area. Long term, I'm strong on Archer-Daniels-Midland, but my fundamental analysis says, hey, it's going to be range bound for a while. You still can play it. Here's a bear call spread. It says, hey, look, over the next 52 days, September 15th, I could sell a 90 and buy 92.50 and only have to put $250 on margin, and I'll get $62 in my pocket. And the break even is about 50 or 91, somewhere, even we're rounded up. It kind of fits our requirement. Archer-Daniels-Midland, it's going to do good if there's a food shortage. The price might not increase too much. It's just going to be a safe place to put your money. I like safe. So you have to ask yourself, is Archer-Daniels-Midland on the daily time frame, each bar is worth a day's worth of data, is it going to stay below this 90.62? And if we do, with only a $250 investment, we'll get $62. And that's about 20%, somewhere in that area. Just had earnings. The last symbol on our list is ticker BG, Bunge. I've traded it many times over this last year. It's an agribusiness company. It's worldwide. And it takes farmers' products and transforms them into ingredients that companies can use to produce other products. With their involvement in developing food technology and ingredients, Bunge is tapping into the lucrative segment of the food industry. Despite symmetrical sales and profitability, Bunge has a history of consistently rising dividends, making it an appealing choice for investors looking for long-term gains. Let's have a closer look. As I said, the ticker symbol for Bunge is BG. 7 days, it went up 4%, and over the year, it's 18% up in price. You want the snowflake to be big and green? This one's kind of pale yellow, but it's a healthy company, paid a reliable dividend, undervalued, and that future growth don't look so hot. Price earnings ratio is 10.5. The U.S. market is 15 or 16, so it's an undervalued stock compared to the market. Earnings are forecast only to grow about 3%. It's trading at a good value amongst its peers, and we'll see that in a minute. We just talked about Archer-Daniels-Midland. Its snowflake is a lot greener, pale yellow, but it has that same projection and trend upward. Here's Bunge amongst its peers, and if you just look at the PE, it's showing a good value. If you incorporate other factors to compute the fair PE, it should be 21, and it's currently at 10.5. Other factors include earnings growth, profit margins. If you're looking at free cash flow, which is the amount of money you have to spend in your pocket, spend on your company, the current price is $108. It's saying, hey, look, really this stock should be trading at 57. Just another way of evaluating it is it says that perhaps maybe it's a little overvalued. And the analysts, all 10 of them, are saying the average target price is going to be 126. Remember, it's trading at 108. That's a 17% increase. That's enough. And they look like they were dead on. Not here, though. The purple line is their projections, and they didn't quite get it. This is where they projected, and they hit it. These guys don't get it right all the time. They're guessing, too, just like you and I. Only thing is, they're getting paid for their guesses. Looking at the charts, the earnings is coming in a few days. You might want to hold off on this one, see what it's looking like. But look at that projection. Wow. Let's spread that out a little bit so it doesn't look so high. MAC is above the zero line. The stochastic is in its overbought situation. So is the RSI, but they haven't come back around yet. This could still be going up. Here's your earnings. There's no telling what to do here. But I do think it's going to pull back. How about let me know in the description below, the comments below, what you think. Is it going up or is it going down? So we talked about 3 stocks today. John Deere, the future of farming. And if there's a food shortage that would lead that it needs to be improved techniques and more equipment, self-driving tractors, some automation, John Deere is going to be in there. We talked about Archer-Daniels-Midland, ADM. I've traded it often. Managing the supply chain, transporting agricultural products and processing them, grain elevators, shipping. If you're interested in that, that's a company you might want to own. Pays a dividend. And last but not least, we talked about Bunge, ticker symbol BG, which takes agricultural products and processes them into other products, like where it can be made into other things. Processing grains and corn into other products and then shipped out. All of these stocks offer some stability and growth in these changing times, especially during the war in Ukraine and other uncertainties like inflation, recession. As always, this is not a recommendation. Do your own research, but hey, I'm hoping you have a watch list of stocks that you know and love, and perhaps maybe putting one of these, that's your action, put one of these on your watch list and start following it for price. See if you can guess or predict, just like the analysts do, whether it's going up or down. And that's what I do. I track my assumptions and see if I'm right later on. And if I get more rights than wrongs, then I can become a consistent trader. Hey, like what you do, learn it, and win. Happy trading. We'll catch you on the flip. Remember to like and subscribe and leave a comment.